Good day, fellow investors. Oil stocks like Exxon, Chevron, Shell might be hit hard by reality. Now, things still look good, but the underlying fundamentals are not good. Here also Chevron a little bit more down than Exxon. Shell still at the, let's say, highs cycle because of the good fundamentals, the good dividend yield, and especially buybacks that are keeping these stocks high, but that is based on past good cash flows. The thing is that if you look at oil prices, we have had relatively good and high oil prices in the cycle, but now we are already down and close to what is the break-even price for these big companies, which means much less cash flows. From an average of 80 going to an average of 60 makes a big difference, and the market still hasn't reacted to lower oil prices, possibly for longer. We don't even have to mention that we haven't had a proper recession over the last 15 years, which could also be a factor. Interest rates are higher and persistently higher. That's something we'll discuss this weekend. And the oil cycle might be turning, and perhaps a key factor for that oil cycle change is exactly what oil majors are doing. If you look at whatever presentation there, Chevron, higher returns, Shell, beyond 2020, free cash flow growth. If we look at Exxon, new markets, 20 billion of improvement, additional earnings 20 billion, additional cash flows 30 billion, outlook, everyone is looking 6-8%, 3-6% growth. So this is Chevron again. New basins, and then you look at the numbers, everything is growing, but the break-even is 75% below 50, can be 49 is below 50, but 25% is above 50. And then if you look here at the present value at 10% break-even, which is, let's say, a normal return, a lot is 50, 60, other players have 60, 40, 50, but it's not unusual that oil prices stick at break-even for longer, which means just a little part of the production would be positive there. And that's the nature of cyclicals, the nature of commodities, where it is a cycle, and that cycle means that not everybody can make money all the time. That's the nature of cyclicals, but the market isn't showing that yet. I've been looking a little bit deeper into oil because I want to understand where we are in the cycle now. That's why you see a little bit more of oil videos, and perhaps the best thing to follow and have a structural value investing long-term perspective on things is to look at my research platform, because to me investing is a process over the long term, over the years. And if you look at my curriculum, I have a few portfolios depending on what you are looking for, very focused value investing opportunities, diversified. And then the thing is to cover stocks over those cycles. Every business has a cycle, and then know when something is low risk and high reward. This is my research platform. This is the selection of 7 years of work here that you can check in the curriculum. Don't get overwhelmed there. But if you look at some of the comments there, you get a value investing mindset and look at the global market with a lot of focus, no Wall Street noise, buy-sell notifications from what I do. Of course, I'm there always to answer questions, very positive returns. So check my research platform in the link in the description below, because these videos are just small parts of the comprehensive strategical approach one needs to have to add, let's say, the value investing part to his portfolio. But let's continue with oil and that exact cycle, which will create value investing opportunities over time. Because if I look at JP Morgan, we already discussed this, but they project 60 and 50 8 per barrel. This means that we could also see 40 for a year. These are their linear average projection models. If there is 40 or just 50, many US producers don't make any money, Chevron, Exxon make much less money, and then that leads to less buybacks, less dividends, less investments, less growth, less everything. Only below 50 shale production starts to decline, and then if that is longer, then we have really structural changes. But that longer can last for a few years, and the administration has made it clear they want 50 oil to lower inflation. And then also, if you look at their plans, Chevron plans to sell 10 to 15. But if oil is at 50, this will not be 10 to 15, this will be 5. That's a big change there. So maybe there will be no growth, there will be no additional cash flows, there will be no maintaining the annual buyback, and we'll discuss that and an example in a few minutes. So not everybody can grow and make a lot of money. That's simply not the nature of cyclicals. Also, Shell, they are going to lower costs, increase free cash flows, but also look at this. They are going to get a return on average capital employed above 10%. But you have to also look at the assumptions. If we look at the assumptions they have, they are basing their assumptions of 70 oil. What if it is 50? Everything changes. Shell assumption here also 70, and Exxon 65, but then using inflation of 2.5%, which means over 10 years the price goes to 83 and then 70, 73 on average. So all have similar assumptions, but those assumptions don't work, are not equal with oil at 80, 60 or even 50. We as value investors, we wait for their structural opportunities of low risk, high reward, 50 or below, for making big plays. I'm thinking of starting already now a small position in the diversified portfolio that I can then increase, because you have to understand the sensitivities. $1 change in barrel, we are from 75 assumption, let's say, to 60, that's 15 times 650 million is 8-9 billion, which changes all the cash flows projected from these big companies. And the key is to understand that the oil cycle can also last for a decade. This is inflation adjusted. Let me go to the 80s. You see here high oil prices, everyone is investing, leads to low oil prices, little investments, and then you have some spikes here and there, but you have also these downturns. Downturns lead to low investments and then to spikes. This was in line with the Chinese boom emerging, growing demand. Here everyone was flushed with money investing. Goldman Sachs was saying oil at 200, and then it led to 5 years of ugliness for oil, and we'll see later what these 5 years meant for Exxon buybacks, for example. Then relatively high prices, high cash flows, that again leads to lower oil prices. That's the nature of the cycle, and the cycle can last for a few years. 5-6 years is normal for those investments to work, because high investments lead to low prices lead to low investments, and consequently high prices. That's the nature of commodities. The cure for low prices are low prices, the cure for high prices are high prices, because everyone is flushed with money, investments, growth. As everyone is projecting growth now, that usually means a decline for longer. And I want to show you this. Look at the capital expenditures. High prices, everybody is investing. High prices, high investments, that leads to low prices and then significant cost reductions, low investments, low everything. Then again, when we have higher relative prices, investments grow. But demand has been growing there all the time, but we have to understand the cycle across that demand. And that demand is not growing that fast. Further, now, still kept high, the stock price is because of the high buybacks on the high cash flows that are still coming in. The new oil prices haven't been reflected into the new financials, and you need 12 to 18 months for that to be reflected. So look at the high buybacks. When did Exxon do high buybacks? High oil prices, high oil prices. Then when the oil prices are low, stock prices are low, no buybacks. When the oil prices are high, buybacks, 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 no buybacks, no buybacks. That's the nature of these oil companies. High buybacks, high, no buybacks. Stupidity squared. The key risk for oil companies, especially for the major players, is that reality just hits and everything, all the assumptions, everything changes. Because the prices are still high, so it would be short candidates, miners as Equinor, which cannot be called a miner, but the price has there already adjusted 50% down. It's an interesting time to start watching, perhaps having some exposure to the cycle, and limited exposure, increased optionality, which is something I do on my research platform with the strategic approach to that. Buybacks are terrible when done with cyclicals because they usually and always keep doing them at the wrong time, wrong place, completely wrong. I would put these people in jail instead of doing the opposite, and only Buffett does the opposite. That's the current situation with oil. I hope I have given you value. For more value over the next cycle, which might last 5 years, 10 years, check my research platform.